Right, welcome to the top 5 charts of the week. This is a weekly run through of 5 interesting and useful or insightful charts across global macro and global markets. And the first one here is the flash PMI for developed markets, the composite, versus the US 10-year bond yields. And you can see here, so in the red line there, what we've got is a composite of the market PMIs. It's GDP weighted. The most recent reading, it's the November flash readings, which is a sort of preliminary reading before the end of the month. Now this chart was really useful for me in picking the surge in bond yields in late 2016 and again in 2017. Those were pretty key calls at the time, and this was one of a few different charts, but one of the key ones that I was looking at then. And now it's going in the opposite direction. So it sort of begs the question there, if it was right on the way up, is it going to be right on the way down? And so I think this is going to be a key one to watch. I mean, the other interpretation here is that, you know, at different times we've got leads and lags of one versus the other. So you could see there back in 2013. Now there was, you know, this little thing called the taper tantrum going on there, so you know we can kind of explain away some of that, but in that situation you had the bond yield actually leading the PMI, and if we had that again, then we'd expect to see a re-acceleration in the PMIs, which would be an interesting thing to see actually. And you know, you could actually argue that the reason for this gap now is that actually the economic confidence surveys, you know, the indicators there have just been, you know, too pessimistic simply based on headline risk and market volatility. So it's one to keep an eye on. And number 2 is actually going into the detail of the developed market manufacturing PMIs, and you can see there that Eurozone has been the biggest mover by far, going from absolutely booming to now a little bit more toned back enthusiasm. Similar but not the same extent for Japan, and meanwhile for now US is just sort of plodding along. But I guess probably one of the key remarks here I've made is that, you know, we're ending 2018 on a very different note than what, you know, the kind of tone that was sounding around the end of 2017, where it was this sort of synchronized strength, and now we're in, I've sort of mentioned it here as asynchronized apathy. So, you know, just reflecting more broadly, I guess if you, in hindsight, 2017, we probably ended the year too bullish. And so I guess the risk is that we end this year too bearish. So it's something to think about, particularly as we get into end of year commentary and 2019 outlook season. And in terms of that, I'll be writing my end of year special in the next couple of weeks. Probably be putting that out around the 17th or the 20th of December, so keep an eye out for that. I'll probably make that one available for free actually, so do keep an eye out for that. Number 3 is also a very interesting chart, and for the global picture, and what we've got here is import volume growth put together by the CPB in the Netherlands, and we've got here for emerging markets and advanced economies, and then of course for the world. And this one is again something that's been quite useful for me in the past. You know, looking at this really highlights how you did basically have this sort of emerging markets recession in 2015-16, and now you've actually got emerging market import growth accelerating. So just quite broadly, it's quite an interesting combination of factors really. If you think about how emerging markets were getting really beat up in late 15, early 16, and that was with the backdrop of basically a recession. And now emerging markets have been beat up really significantly again, and that's in the backdrop of actually improving import volume growth, which, you know, it's in particular when you look at emerging markets with cheaper valuations, kind of makes it look rather interesting. But then of course trade war could be distorting some of that. And you know, back in 2012-13, when you had advanced economies dip down into recession, so much of that was going on with the Eurozone crisis. Although of course US did have a bit of a soft patch then as well. And they actually, developed markets kind of pulled EM down at that point. So, you know, whenever you have a big gap like that, it's always something worth paying attention to. Alright, number 4 is global death crossing. So this is looking at the kind of infamous death cross, which here I've noted is it's when a given market's 50-day moving average crosses below its 200-day moving average. And the reason why you use 50 and 200, well, one, the 200 is quite a slow moving, basically an indicator of trend, and the 50-day, well, it just smooths out the price aspect. I mean, you could just use price against 200-day moving average, but you tend to get a lot more choppiness in the signal. And the 50-day, using 50-day instead of price is basically a way of, you know, sort of recognizing that. It's pretty much designed to try and capture major trend changes. You can see here on the chart, the shaded area is when a death cross is showing up. Now, the first thing is to note is that there's quite a few of these instances, and it's not been in all of them, but at least a few of them where it's signaled to be a market. So, you know, if you're trading on this signal, it would have gotten you out of most of the real carnage of 2008, and it would have kept you out through most of the bear market of the early 2000s. But then, you know, you would have got false signals here, there, one, so we'll count them out, 1, 2, 3, 4, 5. Well, it's arguable actually whether you count this one as a false signal, because it would have gotten you out of some of it. And can't quite see, but it looks like it might have gotten you out in that one as well. But the other interesting lens is looking at the breadth of death crosses across countries. So that red line there is the proportion of the 70 countries that we track that have put in a death cross signal, and at the recent data it's at 80%. So the majority of world markets have put in a death cross, and you know, so it's no surprise to see the ACWI itself finally putting in one. There, as you can see, the shaded bars starting to show up. But you know, they did start coming through around the turn of the year, which I guess in hindsight was a bit of a warning. And but, you know, I guess like all breadth measures, these can provide contrarian signals as well, as long as, you know, the market doesn't change its trend. But at this point, you know, with these many markets in a death cross, and with the ACWI itself in a death cross, you know, it's definitely worth noting from a risk management standpoint, because, you know, it can be a false signal, but it can be a true signal, and we're pretty late in the cycle. So last one, US margin debt. So margin debt is something that a lot of people look at. Most people, I think, tend to look at it in absolute nominal terms, and they say, you know, margin debt's reached a new record high, or it's fallen by this amount. And the October stats have drawn quite a stir, and I think for pretty good reason. The way I look at it is to look at the year-on-year change, and this provides a couple of important signals from a market timing standpoint. So the first one is when it accelerates too quickly. And you can see there in 2000 and 2007, around the peak of both markets, you had this very enormous acceleration there. And the way to think about that is basically punters are leveraging up, frantically deploying leverage to try and boost returns. It's basically a pretty good representation of greed. And obviously that's quite a risky scenario, because if they're leveraging up and they're too excessively optimistic, it can be a sign that, you've reached this sort of madness of crowds kind of mania. And then on the flip side is when it goes across the 0% line, so it starts contracting year on year. And that's basically, people that are using margin debt pulling back on their margin positions, like closing out, liquidating their leverage positions, and that could be because they see the market turning, or it could simply be that they've started to feel pain from that, and it could also be just because they're getting margin calls and actually being forced to close out there and reduce their leverage. And so we can see there that these two major bear markets, this crossing below zero of the year-on-year change in margin debt was a pretty reliable signal. Did give a couple of false signals, so back in around 95 I think it was, and there around 2012, and then again in 15-16. Interesting point about that I'd note is back there with the global trade aspect. 2015-16 it was a near-miss global recession. So, the fact that the PBOC, ECB, Bank of Japan all came to the rescue, it was the central banks that stopped that one from working. I guess you could say that. And then now again we've had it actually cross below zero, so the latest reading is minus 0.03% year on year. So it's basically at zero. But yeah, it's I don't know if you'd call it a red light at this point, but it's certainly an orange or a yellow light from the standpoint of traffic lights. So it's definitely again one to keep an eye on alongside that death cross, and and it is one of quite a few warning signs that are actually starting to show up. So on that cheery note, we'll leave it at that, and if you've got any comments, questions, put them in the comment section of the YouTube video, and don't forget to subscribe to the channel, and indeed to get this email into your inbox each week.